When you look at a blueprint for a house, there is this underlying assumption of just pure structural function.
Yeah, totally.
Like you look at the lines on the paper and you see where the plumbing goes, you see where the load-bearing walls are. And the architect just kind of points and says, well, there it is. That keeps the roof from caving in.
Right. The lines on the paper dictate the physical geometry.
Exactly. But today we are talking about a different kind of blueprint.
A really brilliant architect, though, will tell you that a blueprint doesn't just dictate physical space. It actually dictates human behavior.
Oh, that is such a good point.
Like, if you put a kitchen island right in the center of a room, you are actively sourcing the family to orbit around it. The structure determines their daily reality.
Which is exactly where we are taking things today. Because when you step out of physical architecture and into, the world of financial software architecture.
Yeah, the deep code.
Right. Specifically how businesses are forced to report their financial reality. That blueprint isn't just about keeping the ledger balanced.
No, not at all.
We are looking at a structural layout that actively shapes how a business owner understands their own company. It forces a very specific kind of financial psychology.
It really is the absolute definition of code as compliance.
Yes.
Because the software, it doesn't just act as this passive receptacle for your receipts,
Yeah.
Through its hard-coded structures, it actively tells you how you are allowed to think about the economic value you create.
So today we are taking a massive deep dive into the complex DNA of financial software localization.
And we have a lot of material to cover.
We really do. We have this stack of developer documentation, architectural roadmaps, and template designs for the osFinancials and TurboCASH 2026 update.
It is a huge update.
Huge. And for you, the listener, whether you are a developer prepping for a massive structural shift or an accountant trying to catch up on these strict new global standards, or, just someone fascinated by how digital architecture regulates the physical economy.
Which is super fascinating in itself.
Our mission today is to map this entire ecosystem. We are going to uncover how massive, sweeping global accounting standards are literally hard-coded into localized software templates.
Specifically designed for the United Kingdom.
Right. We are getting way beneath the surface level of just like debits and credits.
Because what is so compelling about this 2026 roadmap is how it approaches that friction between human messiness and, well, digital perfection.
Yeah, how a piece of software forces a business to tell the absolute objective truth about its past mistakes.
Without destroying its current scorecard, which is a really tricky balance.
We're also going to explore the mechanics of something called the 5% rule.
Oh, the 5% rule is brilliant.
It is this mechanism designed to prevent a company's financial records from turning into, like, the digital equivalent of an organized hoarder's house.
That is a perfect way to describe it.
By the end of this deep dive, you will understand the secret language of the chart of accounts. You will see how obscure tax codes and international frameworks literally dictate the buttons a local business owner clicks every morning.
So let's jump straight into the source material.
Yeah, let's do it. We are looking at the 2026 roadmap, focusing on those new UK templates. The documentation highlights two main divergent sets of books.
Right, there is a fork in the road here.
Exactly. We have the 4 ENUK generic template, and then we have the 4 ENUK sole proprietor IFRS for SME template.
And that divergence, it's the perfect place to start because it represents a massive paradigm shift in localized accounting.
How so?
Well, the generic template is essentially a legacy structure.
Yeah.
It relies on the terminology that British bookkeepers and accountants have been comfortable using for well over a century.
Right. I was reading the developer notes on this, and they really emphasize the migration away from that legacy language.
They absolutely do.
In the old generic template, a British business would categorize its accounts using very traditional terms. You have your debtors, your creditors, and your stock.
Yeah.
It carries this very cultural, almost, Charles Dickens weight to it.
It carries a massive cultural weight.
Uh-huh.
Those terms are deeply ingrained in the British commercial lexicon.
Right.
I mean, if you walk into any high street shop in the UK and ask the owner about their stock, they know exactly what you mean.
Obviously.
But under the new 2026 International Financial Reporting Standards, or IFRS, that terminology is effectively obsolete in formal standardized reporting.
Wow.
The software template rigidly mandates the IFRS vocabulary.
So it just overrides the culture.
Pretty much. Those debtors you mentioned. The software now forces them to be categorized as trade receivables.
Okay.
Creditors become trade and other payables. And stock is strictly, universally referred to as inventory.
It's a complete replacement of the local dialect with a global language. But why force that shift at the software level? Like if I am a business owner who has called it stock for 20 years, why does the developer of my accounting software care what label I put on the folder?
Because that label is no longer just for you.
What do you mean?
So international financial reporting standards and the older international accounting standards, which we call IAS,
Right.
they're serving as the rigid, unbending skeleton for these new UK templates. The goal here is the creation of a frictionless environment for capital.
Frictionless capital. Okay.
Yeah, if we look at how the developers map this out mathematically, they aren't just changing the text labels on the screen. They are tying those labels to specific international rules.
Oh, I see.
For instance, they use IAS 7, which is the international standard governing cash flow statements, to dictate the exact setup for cash, bank, and petty cash accounts.
Yeah, I noticed the coordinate system in the documentation.
Right, the alphanumeric codes.
Every account has an exact hard-coded alphanumeric coordinate. The cash accounts under IAS 7, they are locked into the B1000 series.
It creates a universal coordinate system.
Okay.
And then IAS 2, which is the standard governing the valuation and reporting of inventory.
Which used to be stock.
Exactly, the old stock. IAS 2 explicitly governs the new G1 to 00000 series of accounts.
That is a lot of zeros.
It is. And then you bring in IFRS 9, which is this massively complex rulebook for financial instruments.
That's right.
In this template, IFRS 9 manages everything from those trade receivables sitting at coordinate G11000000 all the way down to your short-term borrowings at G2600000.
So by existing within this template, the software is just enforcing global compliance by default.
By default, you don't even have to think about it.
Okay, but if I put myself in the shoes of a local business owner, this feels like an incredible over-engineering problem.
I can definitely see why you'd say that.
Right. Why does a small sole proprietor in the UK, say, a graphic designer running a studio out of a flat in Manchester, or like a local construction contractor,
Yeah.
why do they need their software to care about the exact same global IFRS standards that are being used by massive, publicly traded multinational corporations?
That's a fair question.
It feels like reading a manual for building a rocket ship when you just need to fix a bicycle.
That is honestly the most common pushback you hear when local markets are introduced to international standards.
I bet.
And if the software were forcing the full, unabridged IFRS framework onto that graphic designer, it would absolutely crush them under the administrative weight.
It would be impossible.
But the developers are utilizing a very specific framework here called IFRS for SMAS.
Which stands for Small and Medium-Sized Enterprises.
Exactly. And the entire reason developers are hard-coding this specific framework into the 2026 UK templates comes down to one word: scalability.
So it's about building an architecture that anticipates growth.
It anticipates growth, and crucially, it anticipates the need for capital.
Okay, walk me through that.
Let's take your local construction contractor. Let's say he lands a massive regional infrastructure contract and suddenly needs to secure a £3 million line of credit.
Wow, okay. Good for him.
Right. But to get that, he has to approach an international commercial bank. If his accounting software has spent the last 5 years churning out reports using localized legacy terminology,
Like the Dickens terms.
yeah, if his balance sheet is full of debtors and stock, the bank's automated risk assessment algorithms are going to immediately flag it.
Because the bank's algorithm speaks IFRS, it doesn't speak Charles Dickens.
Precisely. The algorithm hits a translation barrier. And in the world of finance, translation barriers equal risk.
And risk equals money.
Risk equals higher interest rates or just flat-out loan denial.
Wow.
But because osFinancials and TurboCASH have built the IFRS for SMES framework directly into the foundational template, that contractor's financial language is already globally understood.
It's pre-translated.
Yes. If he seeks international funding, or if your graphic design studio wants to be acquired by an American tech firm, their historical books do not need to be entirely audited, translated, and restructured.
That saves so much time and money.
It really does. The foundation of their business is already poured like the foundation of a skyscraper, even if they only have a one-story house built on top of it right now.
That completely reframes the entire concept of software localization for me. It's not just about adapting the software to the country.
No.
It's about pre-installing the country's businesses into the global economy.
That's a great way to put it.
But if we are building this skyscraper foundation, how is the blueprint actually drawn? Because looking at the developer notes, to make this global language function, the software has to organize these accounts in a highly specific, rigid hierarchy.
Very rigid.
You can't just list your assets alphabetically, obviously.
No, definitely not.
And this brings us to the visual layout of the balance sheet itself, which the documentation governs through something called the order of permanence.
Right. And this is one of the most striking visual differences depending on where in the world you are looking at a balance sheet.
Really?
Oh, yeah. If you are accustomed to the generally accepted accounting principles in the United States, so U.S. GAAP,
Okay.
the balance sheet there is strictly ordered by liquidity.
Right, which makes intuitive sense to most people, I think. You list the things that are already cash or are closest to becoming cash at the very top.
Yes. In the U.S., cash is always listed first because it is perfectly liquid.
Naturally.
Then you list your receivables because you expect those to turn into cash in 30 to 60 days. Then you list your inventory because you hope to sell that soon.
And you just work your way down.
Exactly. You work your way all the way down the page to the least liquid assets, like your factory building or your heavy machinery.
But the UK and South African templates in this 2026 standard do the exact opposite.
They do. They enforce the IFRS order of permanence.
So let's trace exactly how that is structured in the template. Under the assets, the developers explicitly dictate that all non-current assets are listed first.
Yes.
These are the assets governed by IAS 16, which covers property, plant, and equipment.
Right.
So, looking at the codes, account G1510000 for furniture and fittings, or your heavy manufacturing machinery, that appears at the top.
Correct.
And that comes before your current assets, like G1100000 trade receivables, or your inventory.
And you see that exact same structural symmetry applied to the liability side of the template, too.
Oh, really?
Yeah. Non-current liabilities are mandated to appear before current liabilities.
Okay, so give me an example of that.
So your account G2800000, which holds your long-term borrowings, like a 20-year mortgage on a warehouse.
Right.
That is listed significantly higher up than G2000000, which is your immediate bank overdraft or your short-term borrowings.
I mean, I understand the symmetry, but if I put myself back in the shoes of that business owner logging into their dashboard on a Friday morning, listing the least liquid things first feels incredibly counterintuitive.
It does feel a bit backward at first glance.
Like, if I am stressed about making my payroll run by 5 p.m., the only thing I care about is exactly how much cash I have in the bank right this second.
Of course.
I don't care about the theoretical resale value of my office chairs, and I certainly don't care about the 10-year depreciation schedule of my delivery vans. Why would this massive international standard prioritize the permanence of a desk over the reality of cash?
Well, it is a profound philosophical statement about how you view the fundamental nature of a business entity.
A philosophical statement
Yeah.
in accounting software.
Yes, genuinely. When you order a balance sheet by liquidity, putting cash at the absolute top, you are viewing the business primarily as a transactional entity.
Okay.
It answers the immediate anxious question, can this business survive tomorrow? But the IFRS order of permanence views the business from a much wider, more institutional vantage point. It asks a deeper question. What actually is this business?
So from the perspective of an institutional investor, the cash isn't the business.
No, cash is transient. Cash is just the fuel in the tank.
Okay, I like that analogy.
If I look at a balance sheet and see a massive pile of cash at the top, it doesn't tell me anything about how that wealth was generated. I don't know if you're a logistics firm, a commercial bakery, or a software developer.
You just know they have fuel.
Right. But your non-current assets, your heavy machinery, your proprietary intellectual property, your long-term leases on manufacturing space.
The permanent stuff.
That is your wealth-generating infrastructure. That infrastructure is the permanent defining identity of the enterprise.
Wow.
So by forcing the software to list the permanent infrastructure first, IFRS demands that anyone analyzing the business understands its fundamental nature before they even glance at the transient field gauge of its bank accounts.
That entirely changes how you read the document. It forces you to look at the engine before you look at the gas tank.
Exactly.
And speaking of the engine, there is a really fascinating architectural detail in this roadmap regarding how the accounts are grouped. The developers built in a structural safeguard that they call a legacy buffer.
Yes, the Class 7 reservation. It is such a brilliant piece of defensive engineering.
To give you listening a visual, the chart of accounts is divided into major numbered classes.
Right.
Class 1 is your assets, Class 2 is liabilities, Class 3 is equity, Class 4 is revenue, Class 5 is cost of goods sold, and Class 6 holds operating expenses.
Very standard setup.
But then you hit Class 7, and it is just empty.
Completely blank.
The entire block of codes from G7000 to G7999 is deliberately left blank and marked reserved. The documentation literally calls it a no man's land.
Yeah.
Why would software developers, who usually want to maximize the utility of every single space, deliberately leave a gaping hole in their architecture?
It acts as an isolation chamber during data migration.
An isolation chamber.
Yeah, the developers observed that in older legacy versions of the software, back before strict IFRS compliance was enforced, users would frequently use the 7000 series of accounts as a chaotic dumping ground.
Just throw in things in there.
Right. They would use it for highly specific departmental costs or weird overflow expenses that didn't neatly fit anywhere else.
So if a business owner tries to upgrade their system from a messy 2018 version to this rigid 2026 IFRS template, and they merge their old database.
Well, if Class 7 were actively used for core IFRS functions in the new template, all that old chaotic legacy data would flood in and overwrite or collide with the new structured account.
Oh, that sounds like a nightmare.
You'd have a catastrophic data collision that totally corrupts the reporting engine. So by permanently reserving Class 7 as a no man's land, they're creating a structural airlock.
It protects the integrity of the pristine new framework.
Exactly. It traps any legacy overflow in a harmless, isolated quarantine zone during the migration.
That makes perfect sense for protecting the past. But the documentation also suggests this empty space is about protecting the future.
It absolutely is. Once a business scales to a certain massive level, advanced IFRS reporting sometimes requires a business to report its expenses by function rather than just by nature.
What does that mean by function?
It means instead of just having one giant pool of administrative expenses, you have to strictly separate the costs of research and development from your distribution costs and from your general administration.
Ah, okay.
So by leaving the Class 7 block entirely blank today, the developers have the architectural runway to unreserve it in a future update. They can build those advanced expense-by-function structures later without having to tear down and rebuild the core system.
So they have sealed the database to protect it from the messiness of legacy data, and they've left room for future complexity.
It's very forward-thinking.
But if we are talking about human messiness, we have to talk about daily workflow, because even with this beautifully permanent, future-proofed structure, running a business day-to-day is chaotic.
Oh, always.
You are always going to have strange expenses or weird minor assets that absolutely do not fit into the neat little IFRS boxes.
Guaranteed.
For instance, if I run a marketing firm and I buy a massive box of custom molded rubber stamps for a one-off promotional event, is that an office supply? Is it a marketing expense? Is it a temporary asset?
Confusing.
Right. How does the 2026 standard handle the inevitable weird stuff that businesses generate?
This is where we see the software actively fighting against human laziness. And it brings us to the -900 catch-all protocol.
The junk drawer protocol.
Yes.
When I read this in the documentation, I was so fascinated by the mechanics of it. The blueprint dictates that every single major account group in the software must include a specific sub-account that ends in the digits 900.
Right.
It is a designated space for other or miscellaneous items.
It is highly systematic. And it is deeply anchored in IAS 1, which is the standard that governs the overall presentation of financial statements. And more specifically, it governs the concept of materiality.
Right. So looking at the code base, if you are dealing with inventory, you have your standard material inventory accounts. But then at the bottom of the group, you have G1200900 explicitly for other inventory.
Exactly.
Under revenue, you find G80000900 for other non-operating income. On the expense side, G90009000 for other non-operating expenses.
It's everywhere.
It even exists in the liability section, like G2450900 for other clearing and reconciliation. It genuinely is the kitchen junk drawer.
It really is.
If you own a house, you have to have a junk drawer. You need a dedicated place to throw the spare rubber bands, the dead batteries you keep meaning to recycle, the random tube of super glue.
You can't survive without one.
But the critical difference here is how the software regulates that drawer. Because if you have a junk drawer for rubber bands, that's organization. If your junk drawer expands to take up an entire room of your house, you no longer have a drawer. You have a hoarding problem.
That analogy perfectly illustrates the tension between flexibility and compliance. The developers knows you need a place for the rubber stamps, so they give you the 900 accounts.
But they put limits on it.
Right. To prevent the hoarding problem, they instituted 3 golden rules for this protocol. And the first one is literally called the 5% rule.
Let's walk through the math of the 5% rule, because this is where the software really flexes its authority over the user.
The documentation explicitly hardwires a materiality threshold based on IAS 1. It dictates that if the financial balance inside any 900 catch-all account exceeds 5% of the total assets, or 5% of total revenue, it instantly loses its status as miscellaneous.
Because mathematically, it is no longer immaterial.
Exactly.
If 5% of all the money flowing through my business is sitting in a folder called Other, that is a massive blind spot.
It's a huge red flag.
So what happens when a bookkeeper hits that 5.01% threshold?
The software essentially rejects the behavior. Under IFRS materiality standards, the user is forced to stop dumping transactions into the 900 void.
They just can't do it anymore.
Right. They are required to create a specific, clearly named account, say G1700400, to explicitly identify what that massive pile of money actually represents.
I love that. It forces psychological discipline. We all know that lazy Friday afternoon feeling. A bookkeeper is tired, they have 50 mixed receipts, and they look at a weird invoice and just think, well, I don't know what this is. I'm just going to dump it in and go home.
We've all been there.
The software allows that human grace up to exactly 5%. Once you cross the line, the system demands transparency.
Because if an external auditor, or that commercial bank manager we talked about earlier, pulls your financial reports and sees that 12% of your entire operating expense is just labeled other non-operating expenses, they're going to reject your financial statements immediately.
They'll think you're hiding something.
Yeah. The 5% rule achieves a dual purpose. It keeps the primary, important accounts from being cluttered with tiny, meaningless transactions, while simultaneously preventing the other account from being used as a rug to sweep major financial leaks under.
So that is the materiality threshold, but the developers also institute a second golden rule for the junk drawer, which is naming consistency.
Yes, very important.
They enforce a strict rule that the text description of the account must always begin with the prefix other, followed exactly by the parent group name. Why is that enforced at the code level? Why can't the business owner just rename G9000900 to MISC stuff?
It comes down to how reporting software compresses data. When a bank manager or investor is looking at a company's financials, they don't want to see a 10-page list of every single micro account.
Nobody has time for that.
No, they click a button in the software to collapse the report. This compresses all the sub-accounts up into their main parent groups to give a high-level overview. If the user was allowed to name that sub-account MISC stuff, then when the report collapses, the context of where that money came from is completely lost in the aggregation.
It just becomes mystery money.
Right. But by forcing the strict nomenclature, other non-operating income, when the report is compressed, the lineage and nature of that money remains perfectly clear to the external reviewer reading the summarized version.
It preserves the DNA of the data even when it's zipped up into a smaller file.
Exactly.
That is brilliant foresight. And the third rule. The documentation calls it the total account trap.
This is a purely architectural constraint dealing with database hierarchy. In the database architecture, you have detail accounts, which are the actual buckets you can post transactions into.
The physical buckets holding the data.
Right. And you have group headers, which don't hold money themselves. They just sum up the math of the detail accounts beneath them. The total account trap rule states that these 900 accounts must be strictly flagged internally as detail accounts. If a user or a developer is customizing the system and accidentally changes the property of a 900 account to be a group header, the database logic shatters.
Because you are essentially telling the database that the bucket holding the money is actually just a label for other bucket.
Precisely. The reporting engine's math will fail to calculate the other portion of the parent group correctly, the parent-child hierarchy in the database breaks, and ultimately your balance sheet will fail to balance.
Oh,
It
man.
is a hard structural safeguard to ensure the math always rolls up correctly.
So, to recap the junk drawer, the software forces discipline about where you put things today. It forces a strict naming convention so outsiders can read it tomorrow, and it rigidly caps your messiness at 5%.
That's a summary, yeah.
But that brings up a really compelling question. We're talking about regulating the messiness of the present day. What happens when you find a mess that belongs to the past?
Past mistakes.
Right. Let's imagine it is late 2026. You are running your business, following the 5% rule perfectly, but your bookkeeper is cleaning out a physical filing cabinet and discovers a massive unpaid vendor invoice from 2024 that was completely missed.
That happens more often than you'd think.
Or maybe they discover a huge depreciation error from 2 years ago. You can't just take a 50,000-pound mistake from 2024 and dump it into today's minus 900 account.
No, you absolutely cannot. And this is a major area of focus in the 2026 standard. It brings us to the concept of time travel in accounting.
Time travel.
The software introduces a highly specific, very strict mechanism for dealing with the ghosts of financial years past.
I spent a lot of time looking at this section of the developer notes, and it revolves around one very specific account coordinate, G36000000.
Right.
It is formally named Prior Period Accounting Adjustments.
A very literal name.
But what caught my eye isn't the name, it is where the developers placed it. It is not located in Class 6 with the operating expenses.
Which is where you'd think it would go.
Right, if I have a missed expense, my instinct is to put it with expenses. But G36000000 sits in Class 3. It is buried under equity, specifically inside a subgroup called Retained Earnings.
Which is incredibly intentional, and it is entirely governed by IAS 8. IAS 8 is the international standard dealing with accounting policies, changes in accounting estimates, and errors.
Walk me through the mechanics of this, because treating a past expense as an equity adjustment feels like trying to rewrite history.
You are rewriting history, but you are doing it in a highly controlled, globally transparent way.
The core rule of IAS 8 dictates that when a material error from a prior year is discovered, the correction must be applied retrospectively.
Retrospectively, meaning the standard forces you to pretend the mistake never happened by altering the historical foundation.
Essentially, yes. The theory is that your financial statements must look as though the error never occurred. However, you cannot literally unlock the closed database of 2024 and simply change the numbers.
Why not? The 2024 books are dead and sealed. Taxes were filed based on those numbers. Dividends might have been paid out based on those numbers. You can't alter a sealed year.
That makes sense.
Instead, the software provides G36000000. You take that massive 2024 expense and you post it directly to this equity account in the current period.
I am struggling with the logic of this from an accountability standpoint, though.
How so?
Well, if I am the business owner and I messed up my expense tracking last year, meaning I made my business look vastly more profitable than it actually was to my investors, shouldn't I be punished for that?
You'd think so, right?
Shouldn't I have to take the painful hit on my profit and loss statement this year so that everyone can see the penalty for my mistake?
That is the most common, intuitive human response. We inherently want the punishment to fit the crime, and we want it to be visible in the present day.
Yeah.
But AS8 strictly forbids dumping past material errors into the current year's profit and loss statement. And the software structure enforces this prohibition by separating the accounts.
But why forbid it?
Let's walk through a scenario to understand why. Imagine you are evaluating a logistics company for a potential investment. The profit and loss statement is designed to be a pure, present-day scorecard of operational efficiency.
Right.
It tells you exactly how much money they're making on delivering packages today, minus the cost of the fuel and the drivers they paid for today. Now imagine if that logistics company found a massive £2 million legal settlement that they forgot to record in 2024, and they dumped it into their 2026 profit and loss statement.
Yeah. If I am looking at their 2026 P&L, it looks like their delivery business suddenly started bleeding cash. It looks like their profit margins entirely collapsed this month.
Exactly. It completely distorts the reality of their current operations. An investor looks at the 2026 P&L and panics. But the delivery operations didn't collapse at all. Their current margins are perfectly healthy.
Wow.
You just allowed a bookkeeping ghost from 2 years ago to haunt the present-day scorecard. If you pollute the current year's numbers with last year's mistakes, Nobody, not management, not investors, not banks, can tell how the business is actually performing right now.
So by routing that massive adjustment directly into G36000000, which sits in retained earnings under equity, you completely bypass the current P&L.
Exactly. Retained earnings represents the cumulative profits the company has held on to over its entire history. By reducing retained earnings, you are fixing the underlying equity base.
You're just pulling it directly out of the historical bucket.
Right. You are formally acknowledging to the world, yes, the total cumulative value of this company is worth less because of a mistake we made in the past. But by keeping it off the P&L, you keep this year's operational scorecard pristine.
You force honesty about the cumulative past without destroying the clarity of the operational present. That is an incredibly elegant solution to a very messy human problem.
It really is beautifully designed.
So we have spent all this time examining how the software structure serves these massive macro masters of international finance, the IFRS, the IAS, the institutional investors reading the balance sheet.
The big guys.
Right. But as any local business owner will tell you, there is an even stricter, much more terrifying, and highly localized master that the software absolutely must serve every single quarter.
HM Revenue and Customs.
The UK Tax Authority.
Exactly.
Which brings us to the final and perhaps most intricate piece of this localization puzzle, the tax matrix.
Oh, this part is wild.
And honestly, looking at how the developers built this, the UK templates are a staggering feat of engineering. The chart of accounts isn't just organized to satisfy the philosophical order of permanence for a bank. The VAT, or value-added tax, accounts are structurally designed down to their genetic code to exactly match the physical reporting boxes on a UK VAT return form.
This is where we see the ultimate practical marriage of sweeping international theory and harsh, granular local reality.
Yeah.
Because IFRS provides the overarching conceptual framework, but HMRC does not care about concepts. They require highly specific data sets to be placed into highly specific digital boxes under the threat of severe financial penalties.
They want their boxes checked.
Yes. To bridge that gap, the developers of osFinancials have hard-coded the VAT account codes to map directly to UK tax law, specifically Section 24 of the Value-Added Tax Act 1994.
Let's walk through this matrix because the level of detail is incredible. Let's start with the output VAT, which is the tax that a business collects from its customers on its sales.
Right.
The software blueprint gives us account T2400010.
That coordinate is dedicated to output VAT standard rate, which in the UK is 20%.
Okay.
This captures the VAT collected on the vast majority of everyday commercial sales. If a business sells a consulting service or manufactures a piece of office furniture, the 20% tax they collect hits this specific account.
And crucially, the software knows that the balance of T2400010 maps seamlessly and directly to box 1 on the HMRC VAT return form.
Automatically.
But the UK tax code is notorious for its exceptions. So right below that, the template provides T2400015, which is designated for output VAT, reduced rate at 5%. What kind of transactions trigger the software to route money there?
The 5% reduced rate applies to highly specific legislated categories. The most common examples are domestic fuel and power, or the installation of specific energy-saving materials in a home, or certain types of mobility aids for the elderly.
Very specific thing.
Very specific. If a business happens to sell these items, the software isolates that 5% tax into T2400015, ensuring it never gets mathematically jumbled with the standard 20% rate.
And then there's the category that always causes endless confusion for people outside the accounting world.
Oh boy.
T2400030, which is output VAT 0 rated, where the tax rate is exactly 0%.
Yes, the famous zero-rated VAT.
When I first looked at this, my immediate thought was, why build database infrastructure to track 0% of something? If the tax is 0, no money is changing hands regarding the tax. Why do you need an entire ledger account dedicated to tracking nothing?
It is a brilliant question, and it highlights a crucial, often misunderstood distinction in UK tax law. Tracking that 0 is what proves to HMRC that you are playing by the rules.
Wait, really?
Because in the UK, there is a massive legal and financial difference between a sale being classified as exempt from VAT and a sale being 0 rated.
Break that mechanical difference down for me. If I am the business owner, how does an exempt sale function differently from a 0 rated sale?
Let's start with exempt. If you sell a service that is legally exempt from VAT, like providing certain types of financial insurance or specific medical services, you do not charge your customer VAT. But here is the critical penalty. Because you are making exempt supplies, you are considered outside the VAT system for that specific stream of revenue. Therefore, you cannot claim back the input VAT, the tax you paid, on the business expenses you incurred to provide that service.
Oh, so if I buy a bunch of expensive computers to run my medical clinic, and I pay 20% VAT on those computers, I can't ask the government for that tax money back because the service I provide is exempt.
Exactly. You absorb that VAT as a pure cost.
That hurts.
It does. Now contrast that with zero-rated. Zero-rated items are things like physical printed books or children's clothing, or most unprepared food from a supermarket. If you sell a children's coat, you charge the customer 0% VAT.
Right.
But, and this is the massive difference, zero-rated items are officially classified as taxable supplies. They are inside the VAT system. The government just happens to have set the current rate to 0.
Oh.
Because you are making taxable supplies, you, as the business owner, retain the absolute right to claim back the input VAT on the expenses related to running that clothing shop.
I see it now. So if I buy display racks from my children's clothing store and pay 20% VAT on the racks, I can claim that tax back from HMRC.
Yes, you can.
But to earn the right to claim that deduction, I have to prove to HMRC that my sales, even though they generated 0 tax revenue, were legitimate taxable supplies within the system.
Exactly. The software absolutely must track the gross value of those zero-rated sales in T24000030. It feeds that total into box 6 of the VAT return so HMRC can see your total taxable turnover. Tracking the 0 is literally what unlocks your legal right to claim your deductions later.
That is an incredible piece of systemic logic. And since we are talking about claiming deductions, that brings us to the flip side of the matrix, the input VAT. This is the tax the business pays on its own purchases. The software gives us T2400100 for input VAT standard rate. So that's the 20% I pay when I buy that computer or that display rack.
Correct. And the software automatically funnels the balance of T2400100 directly into box 4 of your VAT return, which calculates the total tax HMRC owes you back.
Beautiful. But the documentation goes significantly deeper into the weeds of compliance here. It outlines the architecture for T2400150, which is designated for input VAT reverse charge expenses.
Ah, yes, the reverse charge.
I have to be honest, when I read that, it sounded like a sci-fi weapon or a specialized maneuver in a video game. What are the mechanics of a reverse charge, and why does the software need a dedicated account for it?
The mechanics of it are almost as complicated as the name implies. The reverse charge is a highly specialized mechanism designed by tax authorities primarily to prevent a very specific type of organized tax fraud. Yeah, it's often called missing trader fraud. It is particularly common in the construction industry or when purchasing complex digital services from outside the UK.
How does the fraud actually work?
Well, in a normal transaction, the seller charges the VAT, collects it from the buyer, and is trusted to hold on to it and eventually pay it over to HMRC. The fraud occurs when the seller collects that 20% tax and then simply vanishes. The company disappears before ever paying HMRC.
Oh, wow, so the government is just out that money.
Exactly. To combat this, the government introduced the reverse charge. Under this rule, the seller does not charge the VAT. Instead, the legal burden flips entirely.
It flips to the buyer.
Yes. The buyer is legally responsible for declaring both the output VAT, as if they had sold it, and the input VAT as a purchase on their own VAT return simultaneously.
Wait, if I am declaring the tax I owe and simultaneously declaring the exact same amount as a tax deduction I am claiming, doesn't the math just perfectly zero itself out?
Yes, it does. From a pure cash flow perspective, the transaction zeroes itself out. No tax money actually crosses between the buyer and the seller.
So what's the point?
Legally, the transaction must be explicitly reported on the VAT return to prove compliance and to keep the audit trail intact.
That sounds horrible for a human to do.
For a human bookkeeper, calculating both sides of a phantom transaction that zeroes itself out is an absolute nightmare. It is prone to endless manual errors. But the software handles it flawlessly.
Because it's hard-coded.
Right. By routing the purchase through T2400150, The software automates that dizzying, simultaneous double-entry logic behind the scenes, populating the correct HMRC boxes without the business owner having to perform mental gymnastics.
And finally, there is one more specialized tax account in the matrix, T24000160, which handles postponed VAT accounting. The developers specifically note this as the modern UK import logic.
Yes, this became a massive operational necessity following Brexit.
Oh, of course.
Before Brexit, importing goods from the EU was relatively seamless regarding VAT. After Brexit, businesses importing goods into the UK suddenly faced the prospect of having to physically pay the 20% VAT at the border to get their goods released by customs, and then waiting months to claim that tax back on their next return.
That would bankrupt people.
It was going to cause a catastrophic cash flow crisis for thousands of importers. Postponed VAT accounting was the solution.
How does it work?
It allows a business to simply declare the import VAT and simultaneously recover it on the exact same periodic VAT return without any cash actually having to cross the border at customs.
Brilliant.
And again, the software uses T24000160 to handle the complex double-entry bookkeeping required to make this happen, meaning the user just sees the net frictionless result.
Taking a step back and looking at this entire VAT architecture, my overarching realization is that the software is effectively doing the tax return for you in real time every single time you log a daily invoice.
It's doing the heavy lifting, yes.
If we go back to the blueprint analogy, it's like you are building a jigsaw puzzle. But every time you pick up a puzzle piece, which is your daily receipt, the puzzle board you are placing it into is already pre-shaped exactly like the HMRC tax form.
That's exactly right.
You literally cannot put the piece in the wrong place without the system's architecture actively flagging the error and stopping you.
That is the ultimate goal of deep software localization. The developers are creating an environment of compliance by default. For a sole proprietor operating in the UK, the massive friction and anxiety of tax compliance are vastly reduced because the complex logic of the VAT boxes is built directly into the DNA of the chart of accounts.
They're built right in.
By simply using the software correctly, the user is simultaneously satisfying the high-minded international theory of IFRS and the harsh putative reality of an HMRC audit with a single keystroke.
Okay, let's pull all of these massive concepts together because we have covered an incredible amount of ground in this deep dive.
We really have.
We started by examining the translation of the macro global language. We saw how the 2026 templates strip away the old, culturally comfortable terms like debtors to strictly enforce standardized concepts like trade receivables, creating a frictionless API for global capital.
And we then explored the philosophical structure of the balance sheet through the order of permanence. We realized that by hard-coding long-term assets to appear before cash, the software forces everyone, from the owner to the bank, to value the wealth-generating infrastructure of a business over its transient fuel.
Then we dug into the disciplined messiness of the junk drawer with the -900 catch-all accounts, learning how the 5% materiality rule mathematically prevents data hoarding.
Such a great rule.
We traveled backward in time with the G3600000 retained earnings adjustments, analyzing how the architecture protects the current year operational scorecard from being polluted by past mistakes.
Crucial for investors.
And finally, we navigated the incredibly complex, highly localized maze of the UK VAT return boxes, from zero-rated deductions to reverse charge fraud prevention.
It truly is a remarkable synthesis. The software acts as a perfect bridge between abstract global economic theory and the granular reality of local tax law.
It really is. And looking at how perfectly engineered this bridge is leaves me with one final, slightly provocative thought to ponder.
Ooh, what's that?
If financial software becomes this incredibly capable, if every single international standard is hard-coded, if every past error is automatically routed away from the P&L, if every junk drawer is mathematically capped at 5%, and if the VAT return essentially fills itself out in real time, does the fundamental role of the human accountant shift?
That is an amazing point.
If the software forbids structural errors, what is left for the professional to do? Are they no longer just a human calculator?
When the database architecture itself ensures that the math is flawless, the value of the human being has to elevate.
Exactly. I think the accountant shifts from being a calculator to being an ethicist. When the software enforces the structural rules flawlessly, the only thing left to audit is human intent.
Human intent, right?
The software knows where the transaction goes, but only the human can ask why the transaction happened. Why did you categorize that specific dinner as a business expense? What was the actual real-world purpose behind that massive inventory write-off?
Because the software can't tell if you're lying about the context.
Right. The blueprint of the software keeps the roof from caving in. It ensures the walls are perfectly straight. But it's ultimately up to the human beings to decide what kind of business is actually living inside the house.
That is a profound way to look at the intersection of technology and human responsibility.
Thank you so much for joining us on this incredibly detailed deep dive into the architecture of financial truth. Keep exploring the systems around you, keep questioning the blueprints you are handed, and we will see you on the next deep dive.